In the silent rooms of corporate skyscrapers, there is a number your employer has already allocated for your role, and it is likely $10,000 higher than what you see on your offer letter. By remaining silent, you are effectively paying a politeness tax that will cost you over $500,000 in compounded wealth over the next decade. Imagine the scene. You've spent 4 years in lecture halls, survived countless sleepless nights during finals week, and finally the email arrives, an offer. For a Gen Z graduate entering the harshest economic climate in recent memory, that PDF feels like a golden ticket. Your pulse quickens. You feel a wave of intense gratitude. You don't want to rock the boat. You don't want to seem greedy. So you click Accept within the hour. But across the digital table, the perspective is entirely different. To you, this is the start of your career. To the corporation, you are a line item in a departmental budget that was finalized 6 months ago.
The hiring manager isn't looking for a friend. They are looking for an asset to be optimized. They have a range. If the budget for your role is $65,000 to $75,000, they will almost always lead with $65,000. They are waiting for you to bridge that $10,000 gap. When you don't, they don't see a loyal employee, they see a discount. This is the entry-level trap. It is a psychological barrier built on the myth that as a beginner, you have no leverage. You are told to be grateful for the experience, to pay your dues, and to wait your turn. But the math tells a much darker story. That initial $10,000 difference isn't a one-time loss. Because most annual raises are calculated as a percentage of your current base, starting lower means every future increase is smaller. If you start at $65,000 instead of $75,000 and receive a standard 3% raise every year, you aren't just losing $10,000 today.
You are losing the interest that money would have earned in the market, the higher ceiling of your next promotion, and the momentum of your entire financial life. By the time you reach 35, that moment of politeness in your 20s has grown into a $500,000 deficit. The silence isn't just a missed opportunity, it is a massive financial liability that you are choosing to carry. The bridge out of this trap isn't built with more hard work or more overtime. It is built with a single, uncomfortable conversation. To escape the trap, you have to stop viewing the offer as a gift and start viewing it as a negotiation between two business entities. One of them is a multi-billion-dollar corporation. The other is you. To understand why this conversation is necessary, we have to look behind the curtain of the corporate ledger. Most employees view their salary as a reward for their time, but the company views it as a line item in a very specific type of calculation called value arbitrage. In the world of corporate accounting, there is a hidden conflict between two separate piles of money, the retention budget and the hiring budget. The retention budget is what a company uses to give you that standard 3% annual raise. It is designed to be as small as possible to maintain the status quo. However, the hiring budget, the money used to attract new talent, is a different beast entirely. On average, the budget to hire a new employee is 20% higher than the budget used to keep an existing one. This creates a financial phenomenon known as the loyalty tax. By staying quiet and accepting the first offer, you are essentially volunteering to pay a 20% premium for your own seat. Let's look at the hard data.
Imagine you are offered a position for $70,000, but the market rate and the company's internal cap is actually $80,000. You might tell yourself it's only a $10,000 difference. You might think you can make it up next year. But when we apply the rule of 72, the reality becomes far more sobering. The rule of 72 is a simple way to determine how long it takes for an investment to double. If you took that missing $10,000 and invested it into a low-cost index fund with an average 8% annual return, that money would double every 9 years. Over a 36-year career, that single $10,000 gap doubles 4 times. That means the $10,000 you didn't negotiate for today isn't just $10,000. It is $160,000 in lost wealth by the time you retire, and that is assuming you only miss out on it once. If that gap follows you from job to job, the total loss grows into the millions. When you realize this, your mindset must shift. You are no longer a job seeker asking for a chance. You are a solution provider negotiating a business contract. The company isn't doing you a favor by hiring you. They are engaging in an arbitrage play. They believe your skills will generate significantly more revenue than your salary costs them. If you generate $200,000 in value for a firm and they pay you $70,000, they are keeping $130,000 in profit. Negotiating for an extra $10,000 isn't being greedy. It is simply adjusting the margin of the deal. But knowing the numbers is only the first step. To actually bridge this gap, you have to understand the specific psychological triggers that move a hiring manager from a no to a yes. Because while the math is objective, the person sitting across from you is not.
They have their own set of pressures, and there is one specific detail about their department's quarterly goals that they are hoping you never find out. To bridge the gap, you must first stop looking at the world through the lens of a job seeker and start looking at it like a market analyst. Most graduates make the mistake of using generic salary sites that aggregate data from 5 or 10 years ago, leading them to settle for numbers that are already obsolete. But the elite players, the ones securing $10,000 bumps before they even sign the contract, they use a different blueprint. This is step 1, the market audit. Instead of looking at the average, you are looking for the 75th percentile. You aren't checking basic search engines. You are diving into real-time data on platforms like levels.fyi. This is where the actual transparency lives. By seeing what peers in your specific city and niche are earning right now, you shift the power dynamic. You are no longer asking for what you want. You are acknowledging what the market is already paying. You aren't a student guessing a number. You are an informed professional verifying a rate. But data alone is just a static number. To make that number a reality, you need step 2, the ROI ledger. Most resumes are a list of duties, a record of things you were told to do. The ROI ledger is different. It is a record of value. It's the process of moving from duties to dollars. If you managed a social media account, you didn't just post content. You increased engagement by 20%, which shortened the sales cycle. If you organized a filing system, you didn't just clean up. You saved the department 4 hours of manual labor per week. Over a year, that is 200 hours of reclaimed productivity. When you quantify your time in terms of the company's revenue, the extra $10,000 you're asking for doesn't look like an expense. It looks like a small commission on the value you've already created. Finally, you reach the moment of friction, the offer. This is step 3, the acknowledge and pivot. When the hiring manager gives you a number that is lower than your audit, your instinct might be to feel insulted or to fold immediately. Instead, you use the exact psychological phrasing designed to keep the conversation open without being aggressive. You acknowledge the offer, and then you pivot. The script is simple. I'm really excited about the role and the team. Based on my research for similar positions in this market and the specific ROI I can bring to your quarterly goals, I was actually expecting a range closer to, and then you state your number. Notice the phrasing. You aren't demanding or asking. You are expecting. It is a professional recalibration.
You are signaling that you know your worth. And more importantly, you're signaling that you are the type of high-level talent who understands the economics of the business. But even with the perfect data and the perfect script, there is one invisible barrier that stops 90% of people from ever speaking those words. It isn't a lack of confidence, and it isn't a lack of experience. It's a specific psychological phenomenon that companies use to keep salaries low from the very first minute of the interview. And if you don't know how to spot it, you've already lost the negotiation before it even begins. Imagine you are sitting in that glass-walled office. You've presented your data, you've shown your value. And then the hiring manager leans back, sighs, and delivers the line they've rehearsed 1,000 times. It's just not in the budget right now. For most people, this is the end of the road. They offer a polite thank you and walk away, leaving thousands of dollars on the table.
But the most successful negotiators know that a no is rarely a dead end. It is simply a redirection. This is where we introduce the leverage play. If the liquid cash isn't available today, you don't accept defeat. You negotiate for time. You pivot the conversation toward the 6-month review cycle. In the corporate world, the standard is a 12-month raise cycle, a slow burn that barely keeps up with inflation. By securing a written agreement for a performance-based salary review in just 6 months, you are essentially hacking the calendar. You aren't just waiting for a raise, you are accelerating your path to that next $10,000 jump by 50%. It is a move that transforms a stagnant entry-level salary into a dynamic stepping stone, ensuring that your compensation catches up to your actual output twice as fast as your peers. By phrasing it as a trial period for your new responsibilities, you make it almost impossible for them to say no without sounding unreasonable.
You are betting on yourself, and corporations love a low-risk bet. You gain the commitment now, so you don't have to beg for it later. But what if the resistance isn't just about the budget? What if you've tried the data, the scripts, and the time-based pivots, and the answer is still a resounding silence? There is a final, more sophisticated strategy that top-tier earners use when the money is truly off the table. A strategy that ensures you still win even if your bank account doesn't see an extra cent this month. And to understand how it works, we have to look at the one thing more valuable than your salary that most professionals are giving away for free without even realizing it. You are paying a subscription you never signed up for. It's called the politeness tax, and it's more expensive than your rent, your car, and your Netflix combined. Every time you choose comfort over a difficult conversation, boom, deducted. Look, in the boardroom, you aren't a friend.
You're a business expense, and businesses exist to minimize expenses. If you let them pay you $10,000 below your market value today, you aren't just losing 10 grand. You're lighting $500,000 on fire over your career. That's the cost of one moment of silence in a negotiation. But here is the secret. The silent room isn't where you lose. It's where you win. You aren't a passenger anymore. You're the architect. Your assignment? Spend 60 minutes this week auditing your market value. Look at the data, not your feelings. The entry-level trap only works if you stay inside of it. Stop leaving your wealth to chance. Subscribe to Simple Money and build your bridge to freedom, one negotiation at a time.
This is my final offer. Take it or leave it.